Hello, welcome back to Core Finance. I'm Matt Brown, joined by Nicole, Elliott, private investor and technical analyst. And we're going to look at the dollar index. Now, we've had a bit of a move to the upside. It seems to be running out of puff. What's going on?
I would agree with you completely, Matt. I think we have run out of puff. And what it is that over the last 2 years almost, the lows, the weakest point that the dollar index got to, and let's not forget, an awful chunk of this is the euro, okay? But the lowest points we sort of got to were at the 92 level-ish. This is not an exact science. And what happened, we went above the top that had capped before in 2015, 2016. January 2017, we hit a multi-year high on the week that Mr. Trump started work. Not when he was elected, when he actually started work.
Well, has he actually started?
Well, make America great again. I mean, one wonders. Yes, we want to export more. Well, this is the simplest way to do it, isn't it?
True.
Crush your currency. And Bob's your uncle. And you can see this tremendous drop, 12% depreciation of the dollar against a basket of major currencies. But it got a bit too fast, too far, too soon. So that's what I'm suggesting. And hence, as you say, we got a little bounce. It's a three-step move, an A, B, C type move, where C is just over 61% the height of A. Now that's what, as you would expect. If on the downside it was all too excessive, when you try to correct, you don't get excess. You sort of fall short because the down move was too big, if you see what I mean.
Yes.
Anyway, so we've stopped there. We've stopped at no particular chart level. This is nothing. We've stopped in no man's land, somewhere between Fibonacci 23% and Fibonacci 38% resistance, which are the red horizontal lines. So we've stopped in no man's land, and we've had three consecutive, probably, down weeks. Obviously, I'll have to wait till the close on Friday, but assuming that nobody very much is going to be doing any trading this afternoon, let alone tomorrow.
Consecutive weeks, isn't it?
No, it'll be three.
Oh, sorry,
It will be three because we've drawn in this week, but I don't know where it's going to close.
Understood.
But I think, I think I'm quite confident here it will. So that's that's another super chart pattern. It's called three black crows. So you've got decent sized candles with decent sized bodies, unlike the peak one, which is a little spiky sort of sad hanging man thing up there in the middle.
And black crows sounds ominous.
It is.
There we
yes. And normally before we used to chart in black and white because we did these by hand, you see. So the black we used to colour the candles in. So I'm going to suggest that these three black crows sometime over year end will lead to another break below 92 and a successful and sustained break below 92, and then over the first quarter of 2018 we'd see further US dollar losses.
So certainly not looking positive for dollar traders or those that are long the dollar, especially into the long Thanksgiving weekend. But in the meantime, Nicole, Elliott, private investor and technical analyst, thank you very much for joining us here on Core Finance.